Let us start the third topic for this session. And third topic for this session we'll be covering is how do you find cost of equity for retained and retained earnings. Now, cost of equity we have covered earnings model and dividend model. There's one more approach we see under cost of equity, that is CAPM model, that is capital asset pricing model. A small modification which we also cover in that. So apart from earnings and dividend model, we also see the capital asset pricing model. Capital asset pricing model is more realistic when we say, and when it takes into account the market return, risk-free return on securities, especially risk-free return we talk about is the government security. The CAPM model try to find out is the return expected on an equity share. So how do you find return on existing share? Talk about shares being traded in the market. Now when shares are being traded into the market, what happens? The risk factor there, and there are also other securities in the market. Other securities in the market which are risk free, right? So we take everything into a consideration when we find return under a CAPM model. So when we find a CAPM model, we take into account the risk-free return on a security. Risk-free return, tell me which securities can be risk-free? Government securities. So we try to find out the risk-free return on a government security. Similarly, add up the beta. Beta refers to systematic risk of a company. Now what is systematic risk? Now when you go deep into finance, you'll see there are two types of risk, systematic risk and unsystematic risk. Risk plays a very important role also when we talk about the companies in short, right? So we take over into the systematic risk faced by a company, right? Similarly, multiply with the market return and the risk-free return difference in short. Market return normally going in the market and risk-free return is of a government security. When you solve this formula, you can also find the return on equity for under a CAPM model. This is how you do CAPM model. Just for information's sake, don't worry, we'll go deep into it in the other semesters and also in future. This timing, know it, how do you find return under a CAPM model based on the risk factor and based also on the other securities which are being traded in the market. So this is how you find cost of equity under dividend, earnings and CAPM model. Now let us continue this topic. For this session, we have covered debentures, we have covered preference, we have covered equity. Let us start. How do you find cost of retained earnings? Now tell me, whom does retained earnings belong? Let us say that. Now, when you see how profits are distributed, if you see, let's start with operating profit, EBIT, that is earnings before interest and tax. Which people get profit first? Debenture holders or loan holders, you minus interest. Remaining profit is called as profit before tax. Interest is tax deductible and minus the tax. Remaining profit is called was profit after tax. Who gets the profit next? Preference shareholder, you minus preference dividend. Remaining profit is called what? Earnings available to equity shareholder, right? Now these earnings available to equity shareholder, now we have seen, out of these earnings, you pay some dividend to one shareholder. Now for example, if I say I am a company, I come and tell you after 5 years down the line, we're looking for a major expansion plan. And when I look for a major expansion plan, I need funds, right? Now, you are the owner of a company, you are an equity shareholder and you must contribute to the risk and as well as the future requirements of an organization. I keep this prospect forward in a meeting and you are like the director sitting. Now you, what do you say? See, your money, your earnings, I'm asking you, don't take it home as dividend. Give me back in the business in the form of retained earnings, right? Now tell me, when will you give me your money? When you see that, see, you can keep your money with yourself only if you find the prospect is very, you can say, fruitful in the long run point of view, then only you'll give your money to me, right? Now if you see some return happening to that money, so you can keep that money with yourself, you can invest it somewhere else. But why will you block your money for 5 years with me? When you see after 5 years you get more return in short, right? Or at least that return which you're getting when you're keeping your money as an equity shareholder. That's why cost of retained earnings are always equal to cost of equity. These equity shareholders' money is only retained earnings and these people expect the same return which they get as equity shareholder when you invest and the retained earnings with them. That's why cost of retained earnings is always equal to cost of equity. And retained earnings is one of the most important source of finance. If you see, it makes a company self-sufficient. Right? It is different from other sources like debentures, equity, preference shares which you have studied. Cost of retained earnings is what? It's same like for your cost of equity as such. It's a cost of an equivalent, you can say, that it's fully subscribed for an issue of additional shares. Similarly, that's why it is measured by cost of equity capital. That's why cost of retained earnings are always equal to cost of equity, because equity shareholder, at least you expect a minimum return which you're getting on your equity shares. You get the same when you give me as retained earnings. That's why cost of retained earnings are cost of equity. The same computation home, be it dividend model or be it earnings model. If I say cost of equity is 16%, cost of retained earnings will also be 16% for the same, based on whatever model or method you followed for cost of equity.